Good morning. Good morning, everyone. Thanks so much for joining. I know we're just a few minutes behind schedule here. We'll just give everyone another minute to join and then we will get started. Really appreciate you taking some time on a Thursday to join me. And I'm looking forward to running through some of these slides today. Okay. All right, so we're going to get started here. Good morning. My name is Joe Stevens. I am a certified SOM. I'm also a certified financial planner. And today we're going to talk about your future, your vintage. And I want to start with a thought. And I feel like it's a really important thought. So, time makes you money, not trying to time the market. Okay. And this theme is going to come up throughout all of these slides today. So I want you to kind of keep thinking about that as we run through. Okay. A little bit of background on me. I grew up on the retail side of this industry at Gerard's Wine and Spirits. We were a family owned group of wine stores at the Jersey Shore. I wore a lot of hats there. I learned a lot of different sides of this business, which I think brings a really unique perspective to what I'm going to talk about today. From there, I spent years at the Gallo Winery as a luxury manager for New Jersey. And then I became a certified financial planner because I felt that nobody in finance understood your world like I could. What I found over the years is people in this industry are brilliant, they're experienced, and they deserve a retirement plan that's as good as their palate. Okay. So today we're going to spend about 20 minutes together. We are recording this, so that will be available after the presentation today. And if you have any questions at all, there's a QR code on this slide, and there'll be a QR code at the end. And I'll also share my email and my phone number. Please drop me an email, give me a call. We could talk through your individual situation together if you have specific questions. All right. Um, so I kept meeting with incredible wine professionals. And what I found was that a lot of them have nothing saved. And it's not because they didn't want to, it's because no one showed them that they had options. So that's what today's presentation is all about. So let's get into it, okay? I want to start with why this gap exists, and then we're going to get into what you can actually do about it, okay? And specifically, the tax moves that are available to you right now in 2026, okay? This is not a sales pitch. There's no products that we're going to talk about today. This is just straight financial education. This is actually the stuff that I wish someone had handed me a pamphlet about, 15 years ago. So I really want to stress if you can stay through module 7, where we get into the action plan a little bit, that's where everything's going to get a little more concrete. Okay. So let's start with the reality of where most people in this room actually are and why it's not your fault. Okay. So I want to cover some really important stats. All right. So 73% of restaurant workers have no access to a workplace retirement plan. That's not a personal failure. That's a structural gap in how this industry is set up, unfortunately. $0. That's the median retirement savings for hospitality workers under age 45. And then 20 plus years before your retirement savings becomes urgent. That's not 20 years until retirement. That's 20 years where most people in this industry don't even start thinking about it. And that's the compounding that they're giving up. That comes back to my original time makes you money, not trying to time the market, right? It's that compounding that matters. At Gerard's, we didn't have a 401k. When I was on the road for Gallo, I had one, but most of the accounts that I called on, Their staff had nothing in place. This isn't on you, but the fix is on you, okay? And that's what we're here for today to point these things out so you can avoid these blind spots. There are accounts built for exactly your situation, and that's what the next 15 minutes is all about, okay? So, let's talk about why April is a really good time to start planning. So, April 15th, that was the 2025 deadline. That just passed. That window closed. That makes right now one of the best moments of the year to get started. Okay. The 2026 tax year is brand new in the financial planning world. Okay. January 1st started the clock. Today you're a few months in. The next deadline is April 15th, 2027. Okay. So starting now, starting in April means you have 12 months to build the habit and max out some of these accounts that we're going to talk about before the next deadline. Okay. That's not a consolation. That's ideal, actually. All right. So in the next module, I'm going to walk through three accounts that you can open this week. All right. You can't go back and fund 2025, but you can make 2026 the year that everything changes. Remember, time in the market, not trying to time it. Okay. So before we talk about each of these accounts, let's talk about how your income actually works because that complexity actually works to your advantage. Okay. All right. So, how many of you have at least two of these income types in a single year? I'm going to guess it's probably most of you. That mix of W 2 and 1099 income is actually really powerful. Any of this 1099 income that could be from doing a private event or consulting or judging at a wine competition, all of that may qualify you for accounts that W-2 only employees can't access. Okay. Reported tips. This can become the basis for your retirement contributions. They're not a liability. They're an asset as part of your plan. Okay. Um, let's talk a little bit about self-employment tax. So if you do have that 1099 income, unlike a W 2, your tax is not withheld. So you're responsible for both sides of the house, right? The employee tax and the employer tax. So that means, on self-employment income, 15.3% of that is going to initially, be owed to the IRS. And this does sound punishing, but remember, you do get to deduct half of that when you file. Okay. So on $40,000 of, 1099 or consulting income, that deduction alone can be really meaningful for you. Okay. And again, like with this variable type of income that a lot of you have, don't think that you can't save because your income fluctuates. That's just a reason to build a plan that works with the variability, not a reason to skip the planning. Okay. When I was managing luxury accounts for Gallo in New Jersey, I had a salary plus side events, and I had no idea that 1099 income opened doors that I didn't know existed. That's what I want to change for this room today. Okay. So here's where we're going to get into the actual tactics. This is what I want you walking away ready to do after today. Okay. So let's talk about the different account options like I touched on earlier. Okay. And I'm going to take this piece by piece. So, what is a traditional IRA? A traditional IRA, think of it as a wrapper around the investment or the money. Okay. The traditional IRA is just that wrapper that the account sits in. And what it means is you're going to get that tax deduction now, and that money or the contribution will grow tax deferred, but you're going to pay tax on the withdrawals when you start taking money out or when the IRS forces you to start taking money out. Currently, that's at age 73, um, something that we will touch on more in an additional webinar. This is the traditional IRA is best when you're in a higher bracket today and you need that deduction. Okay. Remember, we always want to pay taxes at the lowest rates. Okay. So, what's a Roth IRA? A Roth IRA means you don't get the deduction today, but every dollar grows completely tax free. This is really powerful if you're earlier in your career or you have a lighter income year and you don't need that deduction and you can make a Roth contribution because every dollar will grow tax free and then it will come out tax free. Okay. But you don't get the deduction now. All right. A SEP IRA or a simplified employee pension IRA is basically a way to set up an account for yourself if you're self-employed. Okay, you can have employees, but there's rules around that, and it's too complex to get into today. But just know that up to 25% of your net self-employment income can be contributed to this account, which means a max of $72,000 in the year 2026. And that's a massive number, right? So you can open this and fund this anytime before April 15th of next year. Okay. Also, if you go on extension, you have that time period as well. So that's an important note. It's a unique account as well. Remember, again, the SEP IRA is just the wrapper. Okay. You still have to invest the money inside of it. Solo 401ks, these have become really popular because the cost and the ability to set them up has become so much more simplified. Um, I'd probably argue that right now, if you don't have any employees and you, again, like you're doing side work and you can fund this, this is probably one of the most powerful vehicles if you're really serious about maximizing your contributions. The deadline to set one of these up is December 31st of the current year. Okay. And then an HSA, a health savings account. This is really the sleeper account. If you're on a high deductible health plan and you can establish an HSA, which is really technically a retirement account, um, you get tax-free growth and then tax-free withdrawals if you use it for qualified medical expenses. After 65, this just works like a traditional IRA. You can name beneficiaries on it. Incredible tool if you're eligible and you can set one of these up. Remember, you don't have to choose just one, okay? The right combination or mix, it's going to depend on your individual situation. And that's why they call this personal financial planning, right? Because everyone's situation is so different. And that's what a planning conversation is for, okay? So the the big thought here is, do you want the tax break today, or do you want it in retirement? And remember, I'm going to come back to that other thought that I mentioned earlier. We always want to pay taxes at the lowest rates. Okay. So that's really what this comes down to. With traditional IRAs, we want to utilize a traditional IRA in those higher, those stronger income earning years. Years where we have higher tips, right? Big consulting contracts. That traditional or SEP IRA can meaningfully reduce your tax liability right now, okay? Because it's a direct deduction on the contribution, okay? With the Roth IRA, um, to generalize a little bit, these are more effective earlier in our careers or in lighter earning years because we give up that tax deduction now, but everything grows tax free forever. Okay. Obviously, there's rules around these accounts. We can't get into all of that today. But ultimately, that's the difference between these two styles of accounts. Okay. There is no universally correct answer. All right. I've had clients do both in the same year. And this is where, again, a planning conversation will dial this in. My opinion is tax diversification, meaning some pre-tax, some after-tax, Roth traditional is really important. We want to have those buckets that give us flexibility down the road. Okay. And we're not even getting into, non-qualified accounts like just having a brokerage account today, but that's another piece to this puzzle as well. So let's make a little wine analogy here. Like choosing between drinking a wine right now or laying it down and cellaring it, both can be right. It depends on the wine, the occasion, and your palate. Okay? So keep that in mind when we're thinking about these different ideas. All right. So before we talk about building your full plan, I want to make sure that we cover money you're probably leaving on the table right now. And, obviously we want to legitimately and legally do this with the IRS's blessing. Okay. So let's talk a little bit about some, deductions that I've found over the years that are very specific to this industry. Okay. So, um, if you have self-employment income, these are some things that might apply. All right. So certification exams, right? The WSET fees, the Court of Master Sommelier fees, the study materials. These are all potentially deductible if you have self-employment income. That's that 1099 income that we referenced earlier. Okay. I see folks leave hundreds, sometimes thousands of dollars here every year because they didn't document it and they didn't keep track of what they spent on during the year. All right. Wine education. So these could be things like, subscriptions, tastings for professional development. We need to document this for the actual business purpose, but if you keep track of this, these are deductible expenses. The home office deduction. This one can be complicated, so we can't get too into it today, but just know that that's available. Business travel, going to trade tastings, going to visit, wineries, industry conferences. As long as there's a primary business purpose here, these could potentially be deductible as well. All right. So we want to keep these receipts and we want to note the business reason and keep track of it. Okay. If you have to pay for your own health insurance and you're completely self-employed, 100% of those premiums, can be deductible. Um, and then again, the self-employment tax deduction, half of your self-employment tax is going to be deductible. So we want to make sure that if you're working with an accountant or a CPA specifically, that none of these are being missed because they add up. All right. I've sat with wine professionals paying thousands more in taxes than they needed to simply because their, accountant had never worked with someone in this profession. So these deductions are legal. They just weren't being taken. So again, we need to document it and keep track of it so we're able to use it. Okay. So let's take a breath. Let's zoom out from these tactics and let's talk about what an actual plan looks like and why just starting, and even if it means starting small, it beats waiting for the perfect moment every single time. Okay. So the best retirement plan is the one you actually start. All right. Not the optimal one, not the perfectly timed one. It's the one that you just get started on. What does that actually mean in dollars? All right. So if you're able to contribute $200 a month, okay, into one of these accounts, all right, and you're able to earn a very moderate rate of return, okay. Let's break that down. That's $46 a week, okay? It's less than a nice bottle of wine. Over the course of 10 years, that becomes $34,000, okay? In 20 years, it becomes $104,000. And then in 30 years, it becomes $243,000, okay? From that $72,000 that was contributed, okay? So again, I want to slow this down because it's so important about the time component, right? You contributed $72,000. The account has $243,000. That extra $171,000 isn't money that you saved. It's money that the time in that account earned you. Okay. So remember, time makes you money. Okay. Not trying to time the market, it's the time component. That's why it's so important to get started. All right. Every month that you wait is a month of compounding that you can't get back. So, again, how do we start this? Well, first we have to open the account. Okay. This is easy. Then we need to fund the account. Okay. Even partially, we just want to get started. And again, step three, automate, systemize, right? Set a monthly transfer up and forget about it. Those are the folks that I see become the most successful. And that's why if your company offers a 401k plan and you're able to contribute to it, that works so well because it's systematic and it's automatic and you don't have to think about it. Okay. Um, and then, again, once a year, we want to sit down with our, certified financial planner who understands your industry and do that full review and, avoid those blind spots that I see so many folks, miss. I've had clients start at $100 a month. Some start at $500 a month. The most important thing here is just to get started. Okay. The amount matters so much less than the actual habit. All right. So let's talk a little bit about variable income, because one of the most common things I hear is I can't make a plan because I never know what I'm going to make. So we need to fix that mindset. So let's talk about it. Okay. Um, so how do you manage that variable and self-employment income component? All right. Well, first, if you have variable income and 1099 or self-employment income, most likely you're going to want to set up quarterly estimated tax payments. Okay. This is because the IRS needs this money to function. They can't wait until April of every year to collect everyone's, income tax, right? So it's a pay-as-you-go system that we have here in America. So if you have 1099 income, the IRS wants these, payments quarterly, right? If you miss these, you're going to have to pay a penalty, all right? So you want to put these dates in your calendar so you're not late on any of these quarterly estimated tax payments, okay? Um, how do we manage, self-employment income? Well, when we get, 1099 or self-employment income, what I'd like to see you do is take 25 or even 30% of that and put it in an account that's specifically to cover the tax bill. Okay. And maybe that's just a high yield savings account or a money market, right? Where we have complete access to that money. We don't want to touch that money for anything but the tax bill. Okay. So when the quarterly bill comes, the money's there to pay it and we don't have to sweat. All right. With tips, we want to, create some type of log. Okay. So we're tracking those as well. Maybe it's just a note in your phone. Okay. The date, the venue, the amount you received. Take 30 seconds, document it, then it's done. Um, there's some other considerations here about, creating an S corporation. Probably a little too much for today's webinar, but just know that, by electing S corporation status, you can reduce that self-employment tax liability if you have higher self-employment income. Okay. This is a conversation I have with a tax professional, CPA, if you're working with one. This is not a DIY tactic. Okay. And then as far as bookkeeping goes, we want to make sure that we have, separate bank accounts for our self-employment income. Okay. There's plenty of free options out there. Creating the habit here, again, it's all about the habits, right? It makes everything else easier down the road at tax time. All right. And then we want to find the right tax professional to work with that knows this industry, and collaborates with your financial planner. Okay. It's all about collaboration and having a team that's always in your corner, always looking out for you. Okay. So we've covered the landscape. Now let's take all these ideas and make it a little more concrete. What I'd like to do next is walk through what I'd do if I were sitting where you are right now. All right. So I want you to pull out your phone. All right. And I want you to open a notes app right now. And by the end of this slide, I want you to have at least one thing scheduled in your calendar. All right. So I'm not going to walk through each of these, bullet point by bullet point, but I'm going to touch on as many as I can. So some of the higher priority items is, review your 2025 tax return. You need to at least know your adjusted gross income, okay? Or your income numbers, right? So go through that. Take a second, take a look at your 1040. Um, Once you know that, then you can decide if you're going to open an IRA, a SEP IRA, a Roth IRA. That can be done in 20, 30 minutes. Okay. Starting those contributions now isn't just possible, it's ideal. Okay. Remember, 12 months beats 3 months. Some of the more medium priority items on this list, we want to gather our expense receipts and we want to start creating that journal, right? We want to check if we're on a high deductible health plan, if we're eligible for the HSA. We want to ask our accountant, if we have that self-employment income, did we max the QBI deduction, the qualified business income deduction? Okay. That alone can be worth thousands of dollars. Okay. Some of our more, lower priority items, we want to set those quarterly tax reminders up if we have the 1099 income. And then we want to book a consultation with a financial planner, all right? Because we want to get the conversation started. So this way we're ready for next year and we start today, okay? Remember, it's all about the time, right? That's all I'm asking. Not 10 things, not trying to be perfect here, just one thing today. So I want to spend a few minutes on something that I feel opens, eyes. All right. Especially for anyone who thinks that they don't make enough on the side to bother. So that again, that self-employment income can qualify you for things on top of what you might have through your full-time job. Okay. So I'm going to give you a couple scenarios here. All right. And I'm going to just break these down as clearly as I can. All right. So scenario A. Okay. This is if you have a, full-time job where you're eligible for a 401k plan, but you don't max it out. Okay. What you could potentially do if you have that 1099 income is set up that solo 401k and max out your deferrals. Okay. So in the current year, the max deferral is $24,500. Okay. So if you did, 14,000 through your main job, your employer, then you could do, another 10,500 on your own outside of that plan, okay, through a solo 401k or a SEP IRA, okay? Just remember that it aggregates to that $24,500 number, okay? If you already maxed out your 401k at work, there's still options, okay? If you have that 1099 income, you can contribute as on the employer side, okay, of your net self-employment profit, okay? And then, this third scenario is, if you're doing all your contributions pre-tax in your, 401k at work, but you still have some room in that deferral bucket, or you want to do, backdoor Roth contributions as, on the after-tax side, you can utilize that as well. Okay. I don't know. Bear with me one sec. I think we have a little technical difficulty here. What did we?
Big PowerPoint day.
Dude, I don't know. That's really weird. All right. Hold on. Oh, that's weird. Okay. I was really feeling that. All right. Um, okay. I think we're back. All right. So let me do, wow. Yeah, what is going on here? It's like not
Is it not opening up?
it's opening up, but then it just keeps crashing. Okay. I think I got it.
Okay.
Okay. Wow, that's weird. Okay. Okay. So I need to go back to this. Okay. Okay. So,
It's not on the screen though, just so you know.
it's not, oh man. All right. Hold on. Ba, 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 ba. All right. I need to go to that. Share. Okay. There we go. Okay.
There we go.
Okay. Very good.
Hmm.
So, yeah. And again, so in scenario C, I think yeah, sorry for the technical difficulty there. In scenario C, we're able to use the, entire solo 401k for mega backdoor Roth contributions after tax. Okay. So you can convert those dollars to Roth dollars inside the plan without an income limit and then get that tax-free growth forever. Um, and also, if you roll your old 401ks into your solo 401k, that could clear the pro rata rule, which reopens the backdoor Roth and keeps it clean. Okay, so that's a conversation with your financial planner and tax advisor. But these are all things that we can be thinking about um, to to help us with our plan. Okay, so your next vintage is worth planning for. All right. The same patience you bring to wine, bring it to this. Okay. You don't need time to time the market. You just need to get in it. Okay. And remember, it's the time that makes you money. All right. So I've got a QR code up top there. Please take advantage of this. I'd love to spend 30 minutes to understand your individual situation. Um, no obligation here, just a conversation about your specific situation so we can walk through your goals, your priorities, and create a plan that works for you. Okay. So that QR code goes directly to my booking page. Book some time on my calendar. Let's connect. All right. We are recording this presentation today. I will share it. And this is content that I feel every wine professional needs. So if you're able to share it with your colleagues who couldn't make it today, I'd really appreciate that. Thank you so much for being here. The fact that you showed up today already means that you're ahead, right? So let's get started. Book some time on my calendar. I look forward to talking to as many of you as I possibly can. Thanks so much, and hope everybody has a great day.